Hey everyone, welcome back to Corporate Decoder. Today, AKAM just filed its second quarter 10Q report, and I'm seeing some interesting shifts that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. Akamai is raising a lot of debt, and their profitability is taking a hit. But is that a sign of weakness or a strategic investment? Let's dive in. So, Akamai Technologies Incorporated is filing its quarterly report for the period ending the 30th of June 2026. This is essentially their report card for the second quarter. The company is a big player in the cloud computing and security space, helping businesses deliver their online content faster and more securely across the globe. Let's start by looking at the company's balance sheet. This is like a snapshot of what Akamai owns and owes. As of the 30th of June 2026, their total assets were about $15 billion, a big jump from just under $11.5 billion at the end of 2025. That growth is largely driven by a significant increase in cash and marketable securities. On the flip side, their total liabilities also shot up, mainly due to new convertible senior notes, which are a form of debt. Total liabilities jumped from about $6.5 billion to over $10.3 billion. This is a huge increase in debt, almost doubling in 6 months. Now let's talk about their income statement. This tells us how much money they made and what it cost them. For the 3 months ended the 30th of June 2026, their revenue was about $1.1 billion, up from about $1.04 billion in the same period last year. That is a modest 5% increase. However, their net income dropped significantly. They reported about $79.4 million in net income for the second quarter of 2026, down from over $103 million in the same quarter of 2025. That is roughly a 23% drop in profit. For the first 6 months of the year, revenue grew about 6% to $2.17 billion. But net income fell about 18% from $226 million to $185 million. This indicates that while they are bringing in more money, it is costing them more to do so, squeezing their profits. Breaking down their revenue by product category, security solutions are a strong performer, seeing a 10% increase in revenue for both the quarter and the first half of the year. This is likely a key growth area for them. Cloud infrastructure services also showed impressive growth, with a 39% jump in revenue for both periods. This is clearly where Akamai is placing a lot of its bets and investments. However, their delivery and other cloud applications business saw a decline. Revenue dropped 6% for the quarter and 6% for the first half. This is likely due to increased competition and pricing pressure in that segment. Let's look at the costs. Their cost of revenue, the direct costs to deliver their services, increased by 14% for the quarter and 13% for the first half. This is a faster growth rate than their overall revenue growth. A big chunk of that increase comes from payroll and related costs, up 8% for the quarter and 7% for the first half. This suggests they are hiring more people to support their growth initiatives. Stock-based compensation also saw a significant jump, up 27% for the quarter and 22% for the first half. This is a notable expense that impacts profitability. Their spending on research and development, which is crucial for innovation, increased by 18% for the quarter and 16% for the first half. This shows a commitment to developing new technologies, especially in those growing areas like cloud infrastructure and security. Sales and marketing expenses also went up by 16% for the quarter and 17% for the first half. This means they are investing more to sell their products and services, likely to push those growing security and cloud infrastructure solutions. General and administrative expenses, which cover things like executive salaries and legal fees, also increased by 15% for the quarter and 10% for the first half. This rise is largely attributed to higher payroll and stock-based compensation. When you adjust for certain expenses like amortization and stock-based compensation, which are non-cash items, their non-GAAP income from operations saw a decrease. For the quarter, it dropped from $308 million to $270 million. For the first half, it went from $615 million to $553 million. This shows that the underlying profitability of their core operations is facing pressure. Adjusted EBITDA, another measure of profitability that excludes even more items, also declined. For the quarter, it went down from $444 million to $416 million. For the first half, it fell from $885 million to $842 million. This is a common trend where despite revenue growth, profitability measures are softening. Now, let's talk about that debt. In May 2026, Akamai issued a massive amount of convertible senior notes. We're talking about $1.75 billion due in 2030 and another $1.75 billion due in 2032. That is a total of $3.5 billion in new debt issued in just one quarter. This influx of debt helped boost their cash position, but it also significantly increased their liabilities. The total principal amount of convertible senior notes outstanding is now over $7.6 billion. Interestingly, the estimated fair value of these notes is higher than their net carrying amount, suggesting that the market perceives these notes as valuable, perhaps due to Akamai's market position and future prospects. Let's look at the risks Akamai has identified. They are concerned about slowing revenue growth, global economic and geopolitical conditions, intense competition, and cybersecurity threats, especially with the rise of AI. They explicitly mention facing tough competition and that this could lead to pricing pressure and losing customers. This is a critical point for any technology company. They also highlight the growing cybersecurity threats, noting that AI could make these threats even more sophisticated. This is a double-edged sword for Akamai as they are in the security business, but also face risks from these evolving threats. They acknowledge that their stock price has been and could continue to be volatile. This is important for investors to consider. Looking at earnings per S-share, basic earnings per S-share dropped from 72 cents in the second quarter of 2025 to 55 cents in 2026. Diluted earnings per S-share also fell from 71 cents to 52 cents. This confirms the lower profitability we saw on the income statement. They also mention their employee stock purchase plan and stock incentive plans, indicating their continued reliance on stock-based compensation as part of their employee compensation strategy. Overall, Akamai is growing its revenue, especially in its key security and cloud infrastructure services. However, this growth is coming at a cost. They are taking on significant debt, increasing expenses across the board, and seeing a notable drop in net income and profitability metrics. This suggests a strategic push to invest heavily in future growth areas, particularly cloud infrastructure and AI, which is impacting their short-term financial results. The key question is whether these investments will pay off in the long run, or if the increased debt and competitive pressures will weigh them down. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like this video, comment your thoughts below, and subscribe for more. All our tools in Discord are in the description.